Understanding bond returns. That's what we're going to talk about here today at the Heritage Wealth Planning YouTube channel. And as you can see, I am in my Sunday best, actually getting ready to go outside and put up my nativity scene and all the solar lights that we have to shine it up and everything. And I didn't want to shower before I did all that because it is muddy here in North Georgia. And as I get muddy, I'll go ahead and come back and take a shower and clean up. But I want to get this video done because I just got done reading the article from my man Bob French over at Retirement Researcher. I figured I'd share it with you. So as always, subscribe down below. Don't forget to put comments, thumbs up, the whole thing. And if you like my little beanie cap, this is what I wore with my daughter when we went to the Winter Classic to see the Bruins play the Habs in 2016. And the Bruins just laid a big fat egg, man. We spent lots of money to go see the Bruins lay a big fat egg in the Winter Classic at Tom Brady Stadium in Foxborough, Massachusetts. So let's dive right into this. So Bob French, CFA. CFA is a chartered financial analyst. So I'm going to just real quick, a little bit of segue here. A CFA is for people who are looking in a deep dive of stock, bond returns, hedge funds, and things like that. A CFA is not a financial advisor so much. So just keep that in mind. A CFP, certified financial planner, if you're looking for someone to advise you on the overall picture, a CFP is what you're looking for. If you're looking for someone to advise you on specific investment strategies, a CFA is what you're looking for. If you have a combination of a CFA and a CFP, you would think that'd be a good thing, but I frankly find that to be a little bit over the top. There's not that back, I don't know, a few years back, there's only like 3,000 CFAs/CFPs. In my opinion, now I know a bunch of people who are both CFAs and CFPs. In my opinion, that just shows me that is someone who has yet to figure out where they want to go. Do they want to go on the investment side or they want to go on the financial planning side? I mean, you got to choose your area of expertise. And if you're doing financial planning in the true way you're doing financial planning, well, heaven forbid that you're actually doing at day-to-day investment management. You can't do that. You can't. One or the other, man. Do a CFA or a CFP. So if you're a consumer and you're wanting to hire somebody as a financial planner and they say, I'm a CFA, I'd challenge that. I'd say, well, how are you going to advise you on financial planning? If you're a consumer and you want someone to manage your money and they say, I'm a CFP, I would say, well, how are you going to do this on a day-to-day thing if you're doing financial planning? Or in the vice versa, how are you going to do financial planning if you're doing financial analysis on a day-to-day thing? So just keep that in your mind. Investment management are CFAs. Financial planners are CFPs. And neither shall the, I don't know, what some Mark Twain thing on that where they don't meet and they shouldn't meet. All right. So let's go to this. Bob French. What is he talks about Occam's razor? We're not getting into that. But all right, stocks get all the attention. They have big, flashy returns. There's always something happening, and you can use them to tell pretty much any story you want. Bonds may not be as flashy, but they do form the bedrock of your portfolio. They are the anchor that keeps your investments grounded while your stocks are blown about by the daily whims of the markets. The most interesting thing about bonds is how incredibly boring they are. I cannot agree with this more. A stock is a tiny sliver of ownership in a particular company. The returns may come at some point, but there's no way you'll know how much you're going to get or if you get anything. But a bond is a contract that says you'll be paid a specific amount of money at a specific time. That means to a large extent, if you hold a bond to maturity, you know exactly what you're getting. I'm telling you, assuming the issuer doesn't default. That says a lot about what bond returns look like, and as a result, how they should be incorporated into your investment portfolio. Folks, I've said this so many times. You know for a fact what you're going to get in a bond if your anticipation is to hold it to maturity. The bond is issued at $25,000 a par. We'll just say that. Par is at $100. All right, so you're buying, I don't know, $25,000 is the bond value. So it's actually par is usually $1,000, but let's just say it's $25,000. It pays 4%. We know for a fact you're going to get $1,000 a year on that as an income base each and every year. And we know for a fact that when that bond matures, you're going to get your $25,000 back. It's literally that simple. As long as a bond doesn't default or has a call option where they can call it from you, and we're not going to dive into that here. But we know a bond is issued at $25,000 as par. It pays a 4% coupon. The bond matures at $25,000 at par, and you've received that 4% coupon from date of issue to date of maturity. Is literally that simple. It cannot be any simpler. A lot of people make a lot more noise on bonds than they need to. As I've said, if you hold the bond to maturity, its returns are largely predetermined as long as the issuer doesn't stop paying the coupon and doesn't go default. The returns don't require much of an explanation. They were determined by the price you paid when you bought the bond, so you don't need to worry about what the markets are doing. Holding bonds to maturity, especially in the context of a bond ladder designed to meet future expenses, can often make a lot of sense. And a bond ladder is simply you got a 3-year bond, a 5-year bond, a 7-year bond, a 10-year bond. So you know for a fact, I got a $25,000 par value 3-year bond, a $25,000 par value 5. And so in 3 years, I'll get $25,000. 5 years, I get $25,000. 10 years, I get $25,000 as the maturity comes to fruition. Could not agree with that more. Now your return. Now, what if you don't buy the bond at issuance? So you buy it on the secondary market. Well, you still know what your return is going to be because you know exactly what the coupon is. You know exactly what you're paying for it. Either is a discount, which is under the par value, a premium, which is above the par value, or the par value. So if the bond was issued at $25,000 and you buy it at $24,000, you're buying it for a $1,000 discount. If the bond was issued at $25,000, you're buying for $26,000, you're buying it at a $1,000 premium. We know exactly what the return will be because the bond, regardless of when you bought it, will come back to $25,000 par value again, unless it defaults. So we know exactly what your return is going to be, regardless of when you buy the bond. We know exactly what it'll be because a coupon will be that 4%. So it's simply, and I'll just use these numbers again. You got a $25,000 bond. That's what is issued at issuance, and you buy for, and it pays 4% as a coupon. And you buy for $10,000. All right. So we know for a fact what your yield is going to be. You're going to get $1,000 on a $10,000 premium. So you're going to get a 10% yield. All right, because the bond is going to mature at $25,000. That's what the par value was, and you paid a deep discount. You got it for $10,000, for instance. You're still getting a $4,000 or a 4% coupon. You're still getting that $1,000 of income because a 4% coupon is on a $25,000 bond is paying $1,000 of income each and every year. So you pay $10,000 for a coupon that's paying you $1,000. All right. So each bond that is issued out there pays $1,000. You bought it for $10,000. That means you are getting $1,000 income off a $10,000 investment. And the nice thing is every year, the bond's going to get closer and closer and closer to that $25,000 maturity, which means not only are you getting that 10% yield, but you're also getting a little bit of a capital appreciation each and every year as well. So there's two ways to make money there. So because of that scenario right there, a lot of people are scavenging the market for discount bonds. Like, oh, I might be able to get a $25,000 par value bond at $10,000. I get the coupon at 4%, again, $1,000 income, plus I'm waiting for the bond to mature. That's a win-win. I get capital appreciation, essentially a deep discount, and I get the $1,000 a year for income. Essentially, in that case, it would be a 10% yield. And you're like, hey, that's a great deal. It can be. It's not nearly as easy as you think because there's always a reason why a bond is trading at such a deep discount. Always a reason. And in this case, in that sample right there, that discount is so deep. The reason it's trading is not because of interest rates going up and causing the prices of bonds to go down. It's because there's some significant fundamental issues with that issuer. We'll just say GM. I'm just using that for example because they're in the news lately. Yes, you are. In that case, you're taking a big risk on the validity of the company to maintain itself, to even stay in business. And so because of that, you're going to get compensated well if it does stay in business. That's just a risk. That's no different than a risk of a stock. That's just a fact. On the other hand, the market for premium bonds is sparse. And very, very few people buy premium bonds because they see it the other way. Like that 25, let me just make myself bigger. That $25,000 bond cost me $30,000, but I'm only getting $1,000 of income. So in that case, I'm getting $1,000 of income on a $30,000 bond. My yield in that case is 3.33. All right, so $25,000 bond is giving me $1,000 income, and I'm paying $30,000, so I'm paying a premium for it. All right, and my yield though is only 3.3% because I'm getting $1,000 on a $30,000 bond. When it was issued, I was getting $1,000 on a $25,000 bond. Why would I do that? And on top of that, the bond is going to mature at $25,000. So I got a $30,000 bond. I'm getting $1,000 of income. But when the bond matures, it matures at $25,000. So I have a capital loss essentially of $5,000. Why would I do that? I'm just telling you, everyone thinks that way. Everyone thinks that way. And so because of that, the market for premium bonds is very, very sparse, which is where the arbitrage opportunity comes, because there's not that many buyers in there, but there's certainly a heck of a lot more sellers. And if you got more sellers than buyers, what happens to the price? The price goes down. That does not mean it'll drop below par value, but it goes down relative to the real value that you can get in there. And that's where a huge opportunity lay in the premium bond market if you want to go that route, because you are paying a higher price for a bond that's going to mature at a lower price. We know that for a fact. You're paying $30,000 for a bond that's going to mature at $25,000. So immediately people say, I'm getting out. I'm not buying that market. I'm not buying that because I don't want to lose money. And on top of that, you're getting only a 3.3% yield on a bond that initially had a 4% yield, or in this case, a 4% coupon. And people say, why would I want to pay a premium for a lower yield? Well, there's a reason for that. Maybe the issuer is incredibly strong. Maybe the other alternative investments are incredibly weak. See what I'm saying? You got to look at the big picture. Don't just look at the thing. And maybe if you actually calculate it, right, you should actually look at it and say, if this was an equilibrium, I should pay $35,000 for that bond, because other bonds similar to that are demanding a $35,000 premium. But this bond right here is only demanding a $30,000 premium. So there could be an arbitrage opportunity there in which you can buy that bond as a premium and maybe turn around and sell it later on. I don't know, but there is opportunity in the premium bond market that I think a lot of people miss, and you shouldn't if you're going to buy bonds. Now, I'm not a fan of bonds, you know that, but generally speaking, if you're going to buy a bond, the premium market is where you should look at. Secondly, on a premium market, the prices don't fall nearly as much in terms of when the interest rates go up on a discount. So what happens there is you pay the higher the coupon, all right, the higher the coupon and the shorter the maturity, the less volatility there is when the interest rates increase. So I'll give you an example. A zero coupon bond literally has zero. There's no coupon. All right, there's no interest. You're starting at $50,000 and 15, 20 years is maturing at 100. That's not a coupon. That's called a zero coupon bond. There's literally no interest that you're getting. So a higher the coupon, a 5, 6, 7% coupon, 8% coupon, and the market average is say 3, 4 or something like that, and you're getting 8. The higher the coupon and the shorter the duration until maturity, the less the volatility will be as interest rate market increases. And right now we're concerned with the increasing interest rate market. So if you're trying to limit your volatility on your bonds, you want to buy a higher coupon, all right, and you want to buy one that's going to mature sooner rather than later. And that could be anywhere from 20 years as opposed to 30, 10 years as opposed to 15, you name it. But just remember that to not eliminate, to reduce volatility in the bond market. Higher coupons, lower maturities, all right, or sooner maturities, I should say, will give you less volatility as interest rates increase. That's for sure. All right, so let's keep diving into this. My wife was texting me there. I just had to check what's going on. All right, good. Sorry about that. Before we go any further, I want to stop a little bit how you actually look at the bond market. You probably heard the term yield curve before. It's usually talked about this mythical thing that the Feds whip like a bullwhip. Like a lot of stuff, finance stuff is actually more prosaic. The yield curve is just what the return of similar bonds held to maturity would be from the same issuer at different maturities. So here's an example. Here's a U.S. Treasury bonds, the same issuer, and here's a maturity 30 years from now. It gives you 3% yield. That's as of 2017. Here's a 10-year bond right there. It was giving you 2.25 back then, roughly in 2017. Now there's giving us about, actually, what are the 10-year bonds doing? Haven't looked for a couple of days. Bear with me just a second. 10-year bonds right now. So back in 2000, it's 3.01. So right here, we had a 2.25 on a 10-year bond on January 13th, 2017. Now those same bonds are yielding 3.013. All right, so 3.013. So that shows you how the interest has gone up almost a full 100 basis points. So that's a pretty significant increase in interest rates, which means the corresponding price on these bonds has dropped significantly for sure. So 2.25, 3.0 right now, 75 basis points on I'll give you exact 0.75 divided by 2.25. That's a 33% increase in the yield on a 10-year treasury bond. So that's how the yield curve works. One that matures in less than a day, or less than I guess that's less than a year. So that's short-term money right there. It's a treasury bill would give you 0.5 of 1% roughly. So that's how the yield curve works. The more you allow the years before your bond matures, the more interest you should receive. That's just how it works. All right. So breaking down bond returns, got yield, which again is this guy right here. I'm buying a 30-year bond. I'm locking up my money for 30 years. I'm going to get a yield right now of 3%. That's one way you look at your bond for returns term. All right. So we got the yield and term. That's a 30 year. It's a 25-year. And you can see the yields go down. So the top two ways to determine your return on bonds is looking at your yield and the term. And the yield is based on the coupon. So the coupon is issued right now. A brand spanking new 10-year bond would issue at 3.013. If you can see that, red right there, 3.013. That's going to be the yield I get for locking up my money for 10 years. So my yield we'll just say 3. My term is 10. So I'm locking up my money for 10 years. I'm getting 3% a year for every 10 years. If I bought a $100,000 bond, that simply means I'm getting $3,000 a year. Now, changes in the yield curve. This is what happens. All right. So this is where things can get interesting when it comes to the bond market. All right. So components of the bond, the two are guaranteed. We know the yield, we know the return, as long as the bond doesn't default. But the changes to the yield curve are where things get interesting. And this is what you get from the cash flows that the bond is putting out. Since you know what the cash flows will be and you know what you'll get paid, you know what the price of the return will be. Using the yield curve as our guide, if we hold a 5-year bond for 1 year, the return we get is equal to the 5-year listed on the curve times the holding period. So I want to go down here to change the yield curve. Okay. We have this. The important thing to take away from this is just that, just like a bond's yield, we have a really good idea what the expected return will be, is going to be even before we buy a bond, because those are both known and observable. We know how long the bond will be until it matures, and we know what its current yield is. Thus, if we hold it to maturity, we know exactly what we're going to get, again, so long as the bond doesn't default. That cannot be simpler. However, if you do not hold it to maturity, that's where the change in yield is going to come. Components of a bond return not held to maturity. The expected of the bond return has 3 components depending on the current yield and future changes in yield. This is where we bring in the uncertainty. When we looked at the term piece of the return, with the term piece, how many years until it matures, we were assuming the yield curve was static. But that's not the case, since the yield curve is just a description of what the market looks like today and is constantly changing. There's things called an inverted yield curve, where the longer you go out, the less return you get, because people want to take that risk. If you look at the early 80s during the heavy inflation of the late Carter era and the beginning of Reagan before Volcker took charge, that's what we had, a pretty significant inverted yield curve. The yield curve looks different now than it did when you started reading this article. I completely agree with that. But just like with stocks, we don't know where the yield curve is heading next. The best predictor of future interest rates is today's interest rates, although that doesn't mean they're particularly good predictions. So the expected return from a future changes in yield curve is assumed to be essentially zero. When we're buying a bond, the future moves are noise. We just don't know what happened, which is if you can hold a bond till maturity, you know exactly what you're going to get. If you're not going to hold the bond to maturity, well, you're going to have some issues to contend with in terms of changing yield curves. Putting it all together, we end up with a picture that looks like this. The current yield provides information about 2 of the 3 components. the yield, which is known and observable, the term, which is known and observable, and the future change in yield is not known and not observable. We just don't know. It's just like future changes in earnings to price on stocks. We just don't know. And this is the uncertainty of some of the risk you'll face when you invest in bonds. So bond risk factors. Almost everything we discuss up to now has left out a massively important part of the story: risk. You can't have returns without taking on more risk. And unfortunately, ignoring does not make it go away. But understanding the risks that you face with bonds is actually pretty straightforward. There are only two risks that you need to pay attention to. That's it. Interest rate risk, the change in yield curve, right? And then the default risk. And default risk is whether or not the company is going to go bankrupt. Interest rate risk is simply, what am I getting if if I sell the bond now, for what the interest rate cycle is at the future? And we just don't know. And so if you hold the bond to maturity and you know you're going to hold the bond to maturity, there's only one risk, which is default risk. That's it. If you're not sure if you're going to hold the bond to maturity, there are two risks. Default risk, the bond going bankrupt, the issuer going bankrupt, and what the interest rates are at the time in which you decide to sell. Interest rate risk is essentially the chance that the interest rates will rise, the bonds you own will be worth less in the future. As a bond's time until maturity lengthens, the effects of the interest rate risk movements on them increases. So that's what I'm telling you about. The shorter term maturity, the less volatile the bond will be. A 0.5% increase in rates will hurt a 20-year bond a lot more than it would a 3-month bond. And investors need to be compensated for taking on this risk. Otherwise, you just keep rolling over 1-month treasury bills. Exactly. And that's going back to the yield curve. So if we go back to the yield curve here, we'll see right here that the longer maturities, the more yield we're getting. We're being compensated for locking up our money for a longer period of time, because we don't know what inflation is going to be. We don't know if Hugo Chavez is going to come back from the dead and hyperinflate things. We just don't know. So that's why we're getting more compensation for the longer we lock up our money. What's really interesting about interest rate risk is that you can see exactly how much you're being compensated for it. The composition is a yield curve, like we just talked about. Normally, though not always, we have an upward sloping yield curve, like we just showed you. Longer maturities, the higher yields you're going to get. That means you have a higher expected annual return on a 20-year bond than you would a 1-year bond. If there's no interest rate risk, you would have roughly the same expected annual return on a 1-year bond than a 20-year bond. Default risk, that's pretty simple. What's the likelihood of the company defaulting? Let's say the U.S. government and Kmart both issue 10-year bonds. The government interest that they have to pay to the buyers of their bond, because the government is literally borrowing money from somebody, and what are they going to pay to those borrowers, would likely be a lot lower than Kmart, which would have to offer more to raise the same amount of money. Just because Kmart's risky, the government's not. So think about it from a mortgage person perspective. If you got 5 properties all leveraged to the hill and you go to the bank for number 6, and they're worried about you keeping your job, they're going to charge you a whole lot more interest because they're got to get paid for the risk they're taking. Other than some guy, Mr. Burns, who owns a nuclear power plant that he owns outright. The debts of the U.S. government are also backed by the full faith and credit of the entire government and all the taxpayers they're in, whereas Kmart's are backed by blue light specials. Exactly. That's pretty much all I want to talk about here. And now he talks about bonds, because we know, the risk on bonds are pretty obvious. You got company A versus company B, or government A versus company B, government B, or company A versus government B. So we know Venezuela versus U.S. Which bond would you rather own? All things being equal, the U.S. We got Apple versus GM. Which bond would you rather own? All things being equal, Apple. Why? Because they got tons of cash. It's just all that simple. We got Venezuela government bonds versus Apple corporate bonds. Which bond would you rather own? Apple, because Venezuela is a basket case. 20 years ago is different. 20 years ago in 1997, Apple was trading at $7 a share, begging Bill Gates for money. And Venezuela was one of the wealthiest, if not the wealthiest countries in Latin America. Which bond would you rather own then? Is Venezuela. So things can change for sure. Bonds are the ballast of your portfolio. They help keep your portfolio on an even keel by allowing you to reasonably and easily target the level of risk you want in your portfolio. And your stock to bond ratio is the main risk in your portfolio because we know exactly what risk and reward we're getting on bonds. The stocks we don't. So we have a little bit of risk here on the bonds, and then we got lots of risk and volatility in the stocks. At the end of the day, though, my concern would be is that the bonds simply don't give you the rate of return net of inflation taxes to make it warranted to in any significant exposure of a retirement portfolio. They just don't, because after taxes and inflation, you are losing money on bonds, forever will be, and that's the concern. But I'll leave that up to you to decide. So I'll put a link to the show notes in this article. Big fan of Bob French, big fan of retirement researcher, by the way. That's my man Wade Fowl. He's got another article on in here on bonds I'll talk about next. So don't forget to subscribe, thumbs up, of course. Comments always help me for sure. And we'll see you next time at the Heritage Wealth Planning YouTube channel. Maybe with or without my Boston Bruins hat. We shall see. Thanks now.